Hey everyone, this is Mark and Natasha from Roofstock Certified Agent Network. And this week we have Joel Broyles joining us from Dallas, Texas. He's one of our certified agents and really does a lot of business with us on both the retail side as well as our institutional side as well. But today we're really focused in on the market demands of what's changing and asking him a little bit about himself, the market, and then we're going to get into a little bit about some special tricks and tips that he has for us and the rest of the agent network. So welcome, Joel. Thanks for being a part, and maybe give us a little bit about who you are and what you do in the SFR space.
Cool. Well, thanks, Mark. Thanks, Natasha. Appreciate y'all reaching out. So happy to join today. Just a real quick background. I was the managing broker for Texas and the VP of acquisitions for Texas for a company called Silver Bay. They're one of the first kind of public REITs in the single family space back 2012, kind of in the early days post great financial crisis, trying to figure this all out. And then have been doing that for broke off from them, and then have been doing that same kind of single family rental investing for high net worth families, individuals since then. So have built out several portfolios here in DFW, several hundred houses over the span of about 10, 11 years or so. So yeah, that's kind of a quick background on me. And then, joined forces with Roofstock, which has been fantastic over the last several months, and really excited to see the growth that is that's happening in 2023. So
Awesome. Well, thank you for joining. Well, we're going to ask some quick questions about what you're seeing in the market, because this is very transferable, even though you're in Dallas and other agents are in the Southeast, Midwest, et cetera. But I think it's all very relevant to be able to share this information. So let's jump in with some questions, and then I'll let Natasha ask a few of her own. So first one, what changes are you seeing in investor habits now versus about a year ago?
good question. So I would sort of bifurcate investors between institutional and retail. So institutional, the big money players have materially slowed, some stopped, and so they are sort of waiting for the dust to settle. I think there's a lot of uncertainty, especially with the big money, Wall Street type investor. The rate environment from 2022, pretty volatile, still figuring out, I think, what they want to do there, or if they're just simply moving to the sidelines with dry powder and waiting. So that's kind of the institutional buyer. They're more cautious, but I think their cost of capital has gone up and they're sort of reevaluating. So that's that group. The retail investor, and I kind of look at an institutional bucket versus retail bucket. Retail bucket is your kind of the traditional mom and pop investor. Maybe they're buying their first or their fifth single family rental, and they just have a different mindset. They have a different time frame. They're not doing it as their job. They're doing it as their long-term retirement, legacy planning, that kind of thing. And so they're not trying to time the market. They're not trying to say, well, I'm just going to wait, and I have 4 PhD economists on staff and they're telling me to wait. Like, they're just like, a good deal's a good deal to me, and I'm going to hold it for 25 years. So who cares? And so I think that's a very valid strategy. It's not something where you want to try to time everything just perfectly and nail the bottom and ride those folks are just like, you know what, if it's a good deal, it's a good deal, and I want to buy for the long term. So who cares? I think that's a super valid strategy.
Awesome. No, that's very valuable. Well, let's talk about making offers, because there's investors that are out there, maybe you're getting leads, but it's about who are the offer makers and what's working. So maybe from a retail perspective, give us a little breakdown about where you're seeing success, whether it's price points or it's just a certain strategy that's really been working, because rates are much higher and it's compressing cap rates, right? And in Dallas, it's been compressed for a little while, right? It's been competitive, but without the institutions, there is some lesser competition. So you give us a perspective of what you're seeing in Dallas.
Yeah, I'll tell you what's not working. Lowball. And so I think that there's a lot of headline reading where, oh my goodness, the sky's falling and it's going to be another 2007, 2008 financial collapse, and the housing market's going to lead, and it's going to be another. So there is some memory still in the marketplace of 2008. And so everyone thinks, well, proximity to the last crash, housing is expensive, it's run up, here in DFW about 60% in 2 years, 2020, 2020, first couple months of 2022. So maybe about 26 to 28 months. Unbelievable run up, right? Same as everywhere else in the country. And so therefore it must crash, right? And so I do not think that's going to happen, by the way, at all. And so what is actually happening then, people are coming in, they're like, well, let's just lowball. Inventory is still tight. So the biggest difference right now is, but I'll just quickly explain why I don't think 2008 is going to happen again. One, inventory. It's kind of the primary driver. You did have kind of this waterfall demand collapse in 2022. People saw the volatility in rates, decided to wait, see what's going to happen. But you did not see a corresponding increase in listings. And so if you have a 3% mortgage, why on earth are you going to go buy a new home for 7% or 6.5%? You're just going to stay. And so these low rates that people have been able to achieve either through purchase or refinance over the last 2 to 3 years have really locked in a lot of supply. So you don't move unless you have to. You definitely don't move for capital gains so that you can not have a home. You know, you're not going to go to your kids and say, well, we have $300,000 of equity. We're going to go rent an apartment now. Like that just doesn't happen, right? So, your supply issue is dramatically different than 2008. 2008 had roughly 4.1 million active homes for sale on the market. There's about 970,000 homes for sale nationwide right now. 3.1 or so million homes short of where we were in 2008. Simple supply demand. So do not think we're going to see this dramatic collapse. I think it would take some significant economic driver to make that happen. So that's a long-winded way of saying what's working, what's not working. What's working is somewhere in the 94 to 96% of closed price to original list price. So we are not in the 100 to 103% over list price. There's not as many multiple offers, but we're not seeing 80%, 88%, 90%. We're not even close to that. So it's a healthy market. Inventory in DFW is on the uptick, I would say, but it's still not 2019 levels even. So we're still tight. I think we're structurally tight until interest rates do something more appealing in the 5s. You're not going to give up your 3.25 for a 6.5. It's just not going to happen. So yeah, I mean, I think you're 94, 95, 96% ratio between accepted offers and original list price. So if you've seen, 2 or 3% list price reduction, you're still going to get pretty close to that, on an actual offer. So beyond that, we're seeing more financed offers get daylight. This time last year, I should say, if you weren't 25%, 30%, or all cash, appraisal waivers, those sort of things, you were just, you were in the back of 25 other offers. Right now, maybe there's 2 or 3. And if you have strong financing, you can get your lender on the phone with the seller, the listing agent rather, and kind of describe how you're qualified and things are good. Those are the offers that we're seeing get accepted. So we're not in a low ball scenario. This is not 2008, 2009. This is like, I think we're almost reverting to a somewhat healthy market. It would be hard not to be healthy after 2022. That was a horrible market, but I think we're starting to normalize a bit. And so I don't think we see this collapse. I don't think there's an imminent doom in the market, anything, far from it. We're not seeing huge price declines. We're seeing, a little bit of healthy behavior. It lists here and you sell it for 5% below where you listed. And that's kind of how it's always been.
I love that. Yeah, it's healthy. That's
Yeah.
what I'm hearing. Is like this is what normal used to look like, and people.
Yeah, it's refreshing.
People quickly lose sight of what was just a few years ago, where supply and demand were much more balanced, and that meant an offer could get accepted that was reasonable and presented well. So I think it's all about going back to the basics as a real estate agent and representing your clients, but not removing all these contingencies that could end up putting everybody in a bind, not only the buyer, but also the agent. And, I'm starting to see that a lot more with litigation even coming up. having removed those things without really properly walking a buyer through the risks. But anyways, no, all really nice updates. And let me ask you one more question about like buyer type, because I think we're digging in pretty deep here. So you talked about what kind of offers or offer makers are really working. Like maybe give me an idea. Are you seeing more cash and that's what's getting accepted? Or is it just buyers making many offers and just saying, hey, I'm not getting frustrated anymore? Like you knew there was buyer fatigue a few years ago. What is the buyer type that you're seeing is having most success and that can be coached, right? That can really adapt to this changing real estate markets where maybe there's some depreciation that will be ahead, right? It's hard to talk somebody into a situation where they're like, oh, next year I'm going to already be losing money in terms of home equity. So who is that buyer that's really going to be the one that is best to work with, that you could just see these, them taking advantage of the current market?
Yeah, great question. So believe it or not, it's not the all cash person right now. It's the person with, 5, 10, 15% down, reasonable financing, and they are fully pre-approved, good solid loan with reasonable down payment, right? So it's not like all cash a year ago was phenomenal, great, wonderful. All cash today is almost synonymous with lowball. And so you're really not seeing like the all cash folks. There's this, I think it's a little bit aggressive. I have all cash, I'm going to lowball, you're super desperate. And that's just not the reality of the market right now. It's not super desperate. Sellers are not it's not a dire situation. It's a relatively healthy market. We're not seeing prices skyrocket 15-20% a year. Year over year. I think we're going to be flat, maybe slightly up or slightly down. I don't have a crystal ball, but I don't think we're going to be dramatically down, and I don't think we're going to be dramatically up. It's more likely we're pretty sideways for a minute. But low inventory, pent up demand, reasonable offers with good financing is what we're seeing be successful. And so all cash really doesn't mean much right now. There's not 25 offers. All cash was a leverage point when you had to compete against a bunch of other folks. All cash usually meant 10-15 day close, and was full list price or a little bit more. All those benefits really have been somewhat neutralized in a market that's only getting, let's say, a handful of offers per listing, which by the way is still pretty great. It was, we've now come out of the kind of the winter doldrums, and on the listing side, we're seeing, several, listings that we have that are, 2, 3, 4 offers. And so we're not super motivated by all cash and lowball. And I don't see the market being that way either.
Awesome. Well, my final question, I'll move it over to Natasha. When it does come to the process of you having a buyer in hand and saying, hey, my coaching suggestion is this right now. I've heard a bunch of different things, and it sounds like, the price point, no low balls, cash isn't king right now. It's all about the high quality offer. And what else is in there that maybe is more coaching on the buyer side to get them to that realization that, hey, this is the market? Like what does your process look like to make sure that buyer is going to be successful, and then guiding them through to making the best offers possible?
So I think there's, in particular with investors, in particular with retail investors, there are maybe 2 or 3 things that we really try to coach them through. One, speed still matters. So even though I'm sitting here saying, hey, cash is not as wildly successful as it has been in years past, speed still is. So you still have to move quickly. Good properties move quickly. And so you need to have your ducks in a row. You need to have your criteria set in your mind, understand what a good deal looks like, and be able to pull the trigger when a good deal presents itself. So and sometimes that takes 1 or 2 iterations of missing on good properties to understand, like the sky is not falling, the market is still moving, and I still need to execute quickly. So I would say execution speed has always been and remains the most important variable. To get to speed, that means you need to know your rehab number. So that's number 2, right? We get a lot of people who say, hey, Joel, I just want to buy a perfect house, 2010 or newer, doesn't need any rehab, and I want it for a deal. And I'm like, well, it's not going to happen. You're competing with the retail market. You want a $250,000 to $350,000 purchase price in perfect condition, 10 years old. So does everyone else, right? So, and you're also competing with the end user in that price point, the FHA buyer. So, those are people who are, there's gazillions of those buyers out there. And so speed matters. Knowing your rehab cost matters. So the other thing I would say is, where can we see more success or a higher offer to deal ratio is if you're willing to do a little work, right? And not be too scared. Hey, I'm out of state. How do I manage this process? Well, paint, carpet's pretty easy. Roofs are pretty easy. HVACs are pretty easy. There's a lot of pieces that we can help folks understand on that, like kind of what I would call like light rehab or light CapEx. I'm not saying knock down walls, redo foundation, repipe a house. I'm saying like, 15 to 30,000 in rehab. That's where you can have an advantage as an investor, because who are you competing against? You're competing against the FHA loan. And so if you're looking at that 250 to 350K price point, that is majoritively FHA. You might get, here and there some conventional borrowers, but they're still going to have appraisers. They're still going to have inspections. They're going to still have issues that seller may or may not be willing to fix. And so if you need a $10,000 or $12,000 roof or a $6,000 HVAC, or, you need, whatever, $6,000 worth of soil dropped around the perimeter of the house, so FHA will loan on it. Those are the houses where investors have an edge if you're willing to do a little bit of work. And by the way, that work comes with, that's sweat equity, right? So you can tend to get a little bit better, kind of discount if you're willing to do some work. So that's where I try to coach some folks is like, look, yeah, if you can buy a 3-year-old house for 20% discount, of course, but that's just not the reality, right? The reality is we are 3 million homes shy of where we were in 2008, and demand is much higher. So it's just not going to happen. So you have to be willing to do the work. You have to be willing to take on a little bit more of a, slightly more of a project than just buy it and throw a renter in there tomorrow. And if you're willing to do that, you'll win more deals and you'll have a little bit more equity. Nothing is for free. Doing a little bit more work will put you in a much better position to get a deal done.
Love that. No, great advice. Awesome. Natasha, what do you have?
Yeah. So talk to us about how you follow up with buyers with your CRM. What's your process there?
Sure. We use a super popular CRM that a lot of brokers use, Follow Up Boss. Follow Up Boss is great. We've been using it for many, many years. It's highly customizable, but there are also some kind of pre-baked, what they call action plans. An action plan is just a sequence of follow-up steps, which is automated and can take it can be an email, it can be a reminder to make a phone call, it can be a reminder to send somebody a text message, or it can be any number of things. But it is a sequence of events that is set in place today for a specified period of time into the future, be that a month or 6 months or a year. And so we in-house have developed those follow-up sequences, and just over experience have kind of figured out what we think is the right cadence. You don't want to flood somebody with 20 phone calls in 3 days. It's going to annoy them and make you, not likable. But you also don't want to call somebody once every 6 weeks. They're going to think you forgot about them. And so it's finding the right balance that is respectful of the person in their time. A lot of times these are, especially on the retail investor side, busy professionals, have day jobs, don't have 3 hours to talk to you, right? So you need to know your business. You need to know your market. You need to know your cost. You need to know what's on inventory. Yet you need to be watching what's available. And then what we try to do is, instead of just calling to ask them how the weather in California is, like, I know what the weather in California is. It's awesome. So it's what we're trying to do is say, hey, look, here's XYZ property on XYZ street. I've underwritten this. It's a 290 purchase price, built in 2007. I think it's going to need maybe about 15 grand of work, subject to a roof and an HVAC. So keep that in mind. Here's what the rents are going to be. I've assumed 5% for vacancy, 5% for annual maintenance, 5% for CapEx annually. Here's the taxes. So we've done the underwriting, we've done the work, and now we're presenting them with value. We're not calling to bug them. We're not calling to just kind of talk.
Yeah.
I don't have time for that either. Like I'm pretty busy too. So what I'm trying to present them is I underwrote for a huge REIT, right? We raised almost $400 million. That company bought almost 11,000 homes. We didn't mess around. And the way to not mess around is know what you're doing, underwrite it, and present a deal. So when I call an investor, what I'm saying is, here's 3 deals that I've underwritten and look good relative to your criteria. So that presupposes that you've already done a good job setting that criteria up on the front end, having a good in-depth conversation, explaining why you're qualified to do this, why they should trust you to do it well, and then executing. So know what you're doing yourself, be able to explain that, communicate it to that retail investor, then follow up with good deals based on what they told you they want, right? So that's, for me, the follow-up is not just, hey, it's Tuesday, call them and ask them what's going on in the Bay Area, right? It's like, no, it's Tuesday. I better have 3 good deals to present to that person because that's what I told them last Tuesday.
Yeah.
And so now you're following up and you're executing and you're building trust. And so that doesn't guarantee those are great deals. You need to go lay eyes on them. You need to go make sure that the diligence works, that the rehab is not 50 grand instead of 15 grand. But you're only going to know that if you are out there and you have a reason to go, get it under contract, go drive it, inspect it, all those things. So yeah, I mean, the follow-up is a mixture of good technology, good CRM, we use Follow Up Boss, good cadence on the action plans, so you're not dropping any balls, and then making sure that what you're providing them is valuable. Don't just send them an email on some, here's 10 tricks to service your HVAC this summer. Like, that stuff's garbage to me, right? That so what? Like, of course I know it's hot. I got to service the HVAC. Like, tell me something I can use. Tell me something valuable. Tell me something I don't know.
Yeah.
That if I knew, I would take action. And so that's really what we're trying to do, is provide value. Every single phone call. If I can't provide value, I don't know why I would call you. And I don't know why you would pick up and talk to me. Like,
I love that. That's amazing. And I think if more agents did that, instead of just putting them on these automated lists, or they're just calling to follow up just to do that, right? You actually are drilling down and it's like, this is why I'm valuable. This is the relationship I'm building with you. That's amazing.
I take these folks very seriously.
Yeah.
They have money to spend. They want to invest. They want to build a legacy. They want to build a retirement. And they want to, that's a serious person. They presumably, a lot of these folks already own homes. They don't need like a realtor. Right. What they need is somebody that knows what they're doing, who can advise them well on a good long-term real estate investment.
Yeah.
And so to me, I view myself much more professionally than, here's some worthless email that doesn't tell me much. Like, so what? Like, you're lumping yourself in with all these other kind of mindless, nonsensical junk emails. That's not who I want to be. That's not who I want them to think of me as. And so, yeah, like that to me, it takes more work. Of course it does. Maybe I do 2 hours worth of homework before I call you.
Yeah.
But you're going to answer the phone because you know that I'm not calling you with nonsense.
That's right.
So yeah, I mean, of the few folks we've gotten over from Roofstock specifically, I think we're in pretty good communication with 4 out of 5.
Nice.
We made offers on Saturday on a quadplex with one of those 4. I met yesterday morning with one gentleman who is, quite serious. He's looking to buy a substantial number of properties through a family trust. It's viable. You don't need 10,000 leads. You need to connect with people who are serious and then provide them value.
Man, that is the best answer. I love that so much. Tell us about the early stage investors. How do you guide them without constant touch points?
It's pretty similar, right? So with earlier stage, maybe you've never bought a house before. You got on Roofstock, you got on some, whatever. You bought a Robert Kiyosaki book. You're like, I'm going to do this. Yeah. So with those folks, it's just patience. It's education. It's understanding their goals, understanding where they want to be in 5 years and 10 years. I talked to a guy last night. I'll give you a quick example. Younger guy, works for Salesforce in the Bay Area. He came from not from Roofstock, from a different source, but he is frustrated with the Bay Area's commuting between 90 minutes and 2 hours every day to get to work from home some, but has to be in the office more now. Frustrated with that commute. makes great money, but cannot afford to buy in the Bay Area. Wants to invest, is really educated himself, but he's never done anything. Doesn't own a primary residence, never bought a house. But he's like, hey, I know Texas is on fire. What do I do? So with that kind of investor, that is somebody who I love that. I dig those folks because we can actually help them really execute. So he wants to do, I want to buy in DFW. I want to try to get a job transfer out there. I want to, buy a primary residence, then rent out 2 of the rooms. And I'm like, yeah, that's phenomenal. Yeah, that is so smart to me. The kind of one of the common phrases there is house hacking, where I'm going to buy and I'm going to have roommates, or I'm going to buy a duplex and live in one side and charge rent on the other. I'm going to try to reduce my overall debt service by having 2 or 3 of these strategies, right? With those folks, it's just education. It's just taking your time, and it's helping kind of coach them through. Here's what a mortgage looks like. Here's what down payment for investment loans look like. Here's what rehab costs look like. Here's, there are baby steps. You should not haul off and buy a 30-unit multifamily if you've never bought a single family home, right? In my opinion. You need to sort of learn the ropes. You need to learn what happens when it's 102 degrees and it starts getting hot in your house. Like, what happened? Or, the toilets, they're stinky. What's going on here? There are some baby steps that you need to take. And so with those folks, we just say, you start by starting, you get educated, you start to network with people like me and like lenders and like title companies, and basically people who can start to help you understand the ropes. But there is no substitute for taking the plunge. If you are not in the game, you are not a player. So you have to play if you want to learn. So that doesn't mean you have to be reckless. It doesn't mean you have to be aggressive or dumb. It means you get educated, you understand your risk by reading, by talking to people, by learning, and then you take action. So with those folks, we just help them take those steps. And I think it helps a lot if you've got a lot of experience. There's fundamentally no difference between, a $5 billion REIT buying a single family property for investment purposes and a 25-year-old guy who's got a great job at Salesforce buying a single family rental. It's the same math. Yep. It's one of the great equalizers. I think it's a phenomenal wealth creation tool. And the reason for that is they can leverage a 30-year fixed rate mortgage over a long duration, and you can secure cash flows for a long duration. So it's a very egalitarian thing in my mind. So it's whether you're a multi-billion-dollar Wall Street fund or you're just some guy that's like, I want to buy a rental house, right? To me, it's a very similar approach. It's education. It's making sure you know the market. It's educating the client regardless of their sophistication level, and then doing what you say you're going to do, right? It's just the same stuff, just scale's different.
Yep. Man. So you've provided me with a lot of value, so I can only imagine how you're working with these investors. So thank you so much for joining us today. That was my last question, Mark.
Awesome. No, really appreciate Joel. And, Joel with Whiterock, SFR, he's been a great player for us in the Dallas area, really just knowing how to nurture both on the retail side and institutional side. So Joel, we appreciate your time today. And if anything, we'll do another check-in just to bring some additional perspective, because the market shifts, the market changes, and buyers need to change their strategies. So
watch out for interest rates.
That's right. It's constantly shifting, moving target. So, but anyways, thank you so much for participating today. This was really fun.
Awesome. Thank you guys for the invite. Appreciate it. Anytime.
Yep. Take care. Thanks.
Thanks. Bye-bye.